Hey everybody, this is Paul doing an actual quick video today, not a long one. This is going to be just a quick little go over the market, go over my account, where the portfolio is currently sitting at. Just a very quick one. So basically, this is the portfolio currently. As you can see, I added AWK, which is American Water Works. I got rid of Verizon. I didn't have much in there at all. Not sure how I feel about Verizon. They've been having a lot of trouble with subscriber issues and whatnot. And if we go into a recession, they might go further down. So it's a good dividend stock. I mean, and don't get me wrong, but I'm not sure I want to hold that one on the way down. So I'm kind of placing my bets on AT&T here for my communications type deal. So this is the portfolio currently. I made this right here. I'll end up posting this on my Twitter. Uh, Basically, this is the chart breakdown at the moment um, for what's going on, how everything works, like what's the plan right now. Now that I'm probably about 6 months into this semi-retirement thing, if you want to call it that. So this is kind of the plan right now. So basically, top five are considered monthly bills right now. And you can see I took the screenshot before I sold Verizon, but just swap in AWK right there. But so the advantages can be adjusted, set income, monthly payers. So that's the goal here. Disadvantages, higher risk due to exposure to growth. I wouldn't even, if I had done this in 2020, maybe this wouldn't even been here, but it's still higher risk due to exposure to growth. Monthly dividends may adjust due to market conditions. So QYLD is a good example of that. That was at point 0.2, and then it went down by about $4 a share or so, and it's at 17.85, so or 0.1785. And then this second section here, this is made up of about five. Also, as you can see here, actually, is it five? It's about six stocks. So the general idea here is less risk, staying with the monthly payer idea, and then easier to reduce risk. So if I need to reduce a position for whatever reason, I could just sell it off. So like say GABX, for example, is basically like a utility ETF. This thing trades sideways for years. The entire point of it is to basically just to hand out that dividend based on that price right there. Gain is kind of like a financial services company. Nusi, as they say. This is kind of a tech play. It's almost kind of like BST, to be honest with you, but it's buying it more towards what would be considered a bottom if we don't go into a recession. But you have O, obviously, Realty Income Core. I could throw $500,000 into O and still feel perfectly comfortable with that investment, no matter the price, because they're just rock solid. And then Main, sort of like Gain, to be honest with you. Just Main's the bigger version of Gain, intermediate lender, which is kind of like a big deal right now as liquidity is drying up from banks and whatnot. And then you can see obviously a little bit lower yield, still some exposure to growth because of NUSI. And then we also have, these are what's considered the long-term portfolio. These down here in blue, these 20. I'm gonna try to keep it at 20. Might end up going to 25 at some point, but far less risk, more diversified, exposure to broader economy, better chance of dividend growth. Dividends are reinvested, so these are dividends reinvested. And then quarterly payers, lower yield, no growth exposure. That's why O is up here versus being down in here, just because it's quarterly. I'm trying to keep this little section to be quarterly. Right now, no growth exposure. This could change. When I up this to 25, I might throw Apple or something in there, maybe Microsoft, but it wouldn't be anything crazy. I've played around with stocks like Cisco before, Oracle, that kind of stuff, and just haven't had any luck with them. So most I might do is maybe Apple or Microsoft, but those are included in these different funds up here. So I'm not sure what I would do. But so that's where so that's how the sheet breakdown currently stands. Um, as you can see from when I took the screenshot, if you might be able to take a guess when I took the screenshot. I took the screenshot before last Friday, and this is what it looks like post Friday and Monday. So this is the portfolio currently 3165. This is because I reduced my exposure to QYLD. I reduced my exposure to BST and redistributed a lot of those funds down here. Um, it's a good thing I did because they fell even further from when I mean, just from when I took this screenshot, you can see it was 1805 here, and now it's at 1773. So just reduce my losses there, move that around, and then basically this is how the portfolio looks now. So we're at about 250, 260-ish average per month, give or take a little. And I'm going to build my base from here. This seems like a much more comfortable area, especially with the definite diversity that I have going on now. Current performance. If I had never bought any tech, I'd only probably be down about 5%. So if I had never bought any of this right here, these guys, this part of the portfolio basically, if I had never bought any of that, I'd probably be up another 8%, possibly, depending on what the rest of where I would have put the rest of the money. But it's hard to avoid losses in this thing. It's possible, but you have to be, you know, it'd be, if you avoided losses just trading stocks, I would like to see how you did it. Probably something like just cash and then something like energy, like, all cash and then all Exxon or something, some crazy stuff like that. Nobody would ever recommend that. And then you can kind of see what the market's been doing. I talked about rates in the last video on Monday, so I'm not going to go too deep into that. Basically, my opinion on rates right now is I don't even remotely believe this rally today. This rally today is based on one word, and that's or. The market priced in 75 at this meeting, which they gave last minute notice on, which killed the market on Monday. And then they priced in 75 for the next meeting also. And then all of a sudden Powell said 50 or 75, and the market literally went up in a straight line. You could have hit refresh, and that's how fast it updated. Like, that was all computers right there. Like, this immediately dove 25 basis points, and this immediately jumped from like negative 200 or whatever it was going to up to positive like 500 or something crazy. Like, it was just crazy. It was that crazy. It's like E-Trade couldn't even keep up with how quick it moved. Like, it was showing the wrong numbers up here for a while. So right now I don't trust that rally at all. Um, right now I'm pretty confident that if we get another CPI report, like if we get a CPI report that comes in kind of still lower, or not lower, but if it comes in at estimate like another 8, if we get another 8.3 CPI report because the housing slowdown and maybe like a gas slowdown, something like, or like some kind of slowdown isn't fed through the market. I mean, it's pretty much, instead of talking about 75, they're going to be talking about why not do 100 basis points. Which, and if they do another 100 basis points, you might as well just take this little curve you see right here, and add it over here. So you see this dip, and just add it over here, and then we maybe bottom at 25%. That's if we don't go into a recession. If we go into a recession and it's somewhere down here, so you have to go all the way out to like something like this to just get a general idea of how low we could possibly go. If you look here, this is like so if you go to the COVID lows, so you can see this is over 3 years, still up 37%. Like, so I'm not too stressed. But if you look, this is the COVID lows, and it's to get back to the COVID lows or something like that, which is where we could potentially go if we get into like a real deep recession with some serious job losses every month. You're looking at 40% down, 30%, at least 30% down, 40%, maybe 50% if we get really deep, hard recession. Even if they do end up dropping rates, it won't matter. It's going to take forever for the job market to recover. It's already going to take forever for the housing market to recover, for those jobs to recover. Like, I think it was like 60% of firms are laying off people right now. It's gonna take a while for crypto to recover. They're all firing people too. Like they're losing talent left and right. Like this is pretty brutal. Um, and that's kind of where we're at. Like as it stands right now, I don't even remotely believe this little right here. This right here, don't even remotely believe this. There's just there's just no chance that's right. I'm pretty certain unless something really dramatic happens with the CPI report, all these gains are going to get completely dumped between now and the next Fed meeting. Um, so we have to kind of see if you start hearing people talk about um, like so here's where we're kind of at right now. This is 16 times earnings and a 235 earnings. Uh, if we adjust earnings and just stay, if we adjust earnings lower and we just stay at 16 times, that's 3,600. Gets knocked right off the top of the market. Um, if they start saying no, next meeting's not 75, it's now 100. Now you have to remember they have to add 25 back to here, and they have to add another 25 back on top of that because they have to front load the rates. So if the CPI report comes in like at a 9, which is entirely possible because oil is not really going anywhere. It is today, but it's not really going anywhere. So we could easily see like a pretty like the same thing you saw Monday, you could easily see that next month. Like you can basically see another repeat of that. And this is the chart that Goldman Sachs made, and they're kind of in this 3150 range. And if we get the Fed, I mean, we're not too far off of that. Like Goldman's saying right here, literally halfway through. Estimate year end 2022, assuming halfway through or halfway revision. So we could go to 3150 if inflation doesn't go anywhere and the Fed wants to ease. You can tell by what Powell's saying. Like they want to ease, but they're going to keep hiking. They're going to keep rates tight. So 3150 is kind of the big area where they think a lot of us might be going. With a 14 and then a 225. There's no telling where it goes. So what do I have going on right now? Outside of the basics, what I just showed you on that sheet right there. I got to turn on dividend reinvesting for these guys, but dividend reinvesting's turned on for all my dividend stocks. Um, I've said this before. As it dips, I'm just going to keep adding positions. Um, I think there's like a saying that says millionaires are made in bear markets, and that's kind of where it is. It's like I'm not trying to time the bottom because if you could have tried to time it right here, I was down 14.34%, or something like that, and now I'm down 16. But we could easily have another bounce higher as we just got the Fed meeting out of the way. So that's kind of what's been going on. Is you kind of get these little lows, and then in between the Fed meetings, we get these little things right here, and then all of a sudden we get a CPI report that says, "Oh no, it's really bad." And then going into the Fed meeting, we dump, and then you kind of get the same thing. So this is literally what's going on. It's like coming out of the Fed meeting, doing great, and then you get the CPI report. It's literally what's going on. This May 20th low right here was right after the Fed meeting, and then we went up, then we went down. So we're just hitting those little technical levels on this little chart here. We set at 3750 on the dot on Monday. That's exactly where we went to. So we could end up, if we get another low or another CPI report that comes out, don't be surprised if we go to 3550. Just don't be shocked, because the market is going to slowly adjust to each one of these things. If it goes from right now, it's back down, it's back to 50 or whatever, which probably means we're sitting at what, basically 37.89. But it's kind of like the market really does have to figure out where once the rates stop. But this is before we even get the earnings. Like once we start getting earnings reports, that's going to help maybe put a floor under this. But until you see CPI go down, it's just the market's just going to keep bleeding. With exactly what you see right here. It's going to go down. Then you might get a little rally in between. And if you could see, this was about a 6% rally. and then we just dumped for this much. So now it went back up. This was about a 5% rally, 6% rally for me, about 5% right there, and then it just dumped. And that's kind of exactly what's going to happen. You might get a little bit of a rally. You actually might get a few little bit more dump in here come tomorrow, especially. And then it might rally a little bit for maybe like 5%. And then it probably is going to dump again. But it all depends on CPI. So, just, like I said, the plan right now, stay invested through the whole thing. Losses are going to be pretty brutal. But nothing much you can really do about it right now. The minute I decided to stay in January and not just go all cash or something like that, or not go all I bonds, it's kind of made my bed and laid in it. So this is where we're at now. Continuing to buy on the way down, and I will continue to buy on the way down, especially in my dividend areas. I expect this to come roaring back. The minute that they cut rates, or they say that they're going to cut rates, or you see CPI just dump hard because housing dumps finally, I expect the market to just effectively go up in a straight line. And today was just perfect proof of that. You take out 25 basis points in expectations, and the market goes up 500 points, at least on the Dow. And you can see here, this is 25 basis points taken out right here. You take out 25 basis points, this is what you get. 50 points on SPY over in a few seconds. Just snap your fingers in a few seconds. So that should give you a general idea what the market's going to do if they think that the Fed's going to like not hike as much, and they can start pricing out some of these hikes. It'll go up in a straight line. But for that to happen, something needs to happen with oil. So yeah, just something needs to happen with oil or housing. One of the two needs to collapse. It's kind of where you're at. It's like one of these two needs to fall through the floor. So either we find a bunch of oil, or housing just slows down to the point that it just starts to collapse in prices, and then that'll control the inflation, and we can finally flatten out. So well, let's see how it goes, but that's where we're at right now. So that's the current plan. Well, thank you so much for listening. You have a nice day.